Hello traders, this is Jake from Optimus Futures, and today we're going to talk about the newly released contract launched by the CME Group called Micro Crude Oil Futures. On your platform, you'll find this symbol under MCL. We wanted to discuss it with you, we wanted to discuss the product itself, and show you how it's a potentially viable way to also trade the energy sector, especially in futures trading. So let's get started. Now, before we get into the meat of things, we want to have you take a look at the slide below. We need to discuss this, and I encourage you to read along with me, that trading futures and options involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results, and the risk of loss in trading commodity interests can be substantial. You should therefore carefully consider whether such trading is suitable for you in light of your financial condition. There's a high degree of leverage that is often obtainable in commodity interest trading, and this can work against you as well as for you. And the use of leverage can lead to large losses as well as gains. As we have seen in the recent past, crude oil prices can also become negative. So please keep that in mind. And now that we're into it, let's get into why you should trade energy. Well, it's simple. There's a supply and demand perspective to these products. These are real physical commodities and they are volatile. But as a day trader, this volatility can potentially help you capture moves in the market. And it's a global market. There's a lot of factors from OPEC to production to seasonalities. And please keep in mind that patterns are not guaranteed to repeat themselves, and many times they do not. But we're going to touch on all that. So even if you've never traded the energy sector before, there is always potential opportunity because it is such a volatile market. And because it's volatile, we believe, in our opinion, that it is a good alternative to at least energy stocks or ETFs or CFDs in oil. For example, in energy stocks, it's not only about the product, but it's about the management, it's about profitability, it's about their margins. Here in futures, you're trading the raw material, you're trading the product itself. And there's no management in futures trading, so you're really trading the raw material itself. It has an advantage over CFD in terms of the spread and liquidity, and you're trading on a regulated exchange. You're not just trading against, the broker that provides liquidity, you're actually trading against another trader. The exchange itself is not in the business of making money as a result from somebody losing money. They simply help the two facilities buy and sell the actual physical commodity. And that makes a big difference. So we believe that you should trade in regulated exchanges if possible. And moving on from that point, if you look at point 4 on your PowerPoint slide here, we could also see that the MCL is great in addition to trading stock indices such as MES, MNQ, or other index-based trading. These micro contracts are very popular. With the addition to the MCL, it does provide great opportunity for diversification. As we have seen, stocks are not always the most volatile products, or the stock indices, and they sometimes tend to become a little bit flat. And, as we've seen in previous years, during certain times of the year, these products can become very flat or choppy. With MCL, there's typically a consistent case of volatility, which, as we discussed before, as a day trader, does provide opportunities for potential moves in the market. And you always have an opportunity to look at something else with these products. It's a seasonal product. As we discussed before, there's never any guaranteeing that patterns or seasonal events will reoccur. Oftentimes the reverse happens, but you can potentially look back at past years, see what happened during certain times of the year, and potentially make an educated decision based on your past research from other years in the market. For example, during the time of year where people travel more, there's typically more demand or potentially less demand depending on the time of the year. And because of that, with more travel means more oil needed for travel. So there are trends that are created as a result of, holidays or, heavily traveled times of the year. Now, again, as we mentioned in the beginning of the disclaimer, and as I mentioned several other times, that seasonality does not mean that something will actually happen. It's not guaranteed, and sometimes we see the opposite happen as we expect, but it's definitely something for you to keep an eye on to see if it'll happen. And like I mentioned, we sometimes see the reverse trends, as opposed to seasonality. We sometimes see the opposite. We've seen it during COVID, as we saw, and as I mentioned in the disclaimer earlier, we've also seen crude oil become negative, which many did not think was possible. But we just wanted to emphasize that with seasonality, when you know the times where crude is supposed to go up again, you can watch these markets and see what they're doing to potentially make an informed decision with your trading. Now, a few other points to make, as you can see on our slide here, that the crude oil products, specifically in our case, MCO, trades around the clock. It is essentially tradable 23 hours a day, 5 days a week. The market is closed 1 hour between 4 p.m. Central and 5 p.m. Central. And the market is closed on Saturday and the early half of Sunday. Other than that, there's essentially opportunity to trade this product, like I mentioned, 23 hours a day, 5 days a week. And for different traders out there, different parts of the world, different volatility spikes up at different part of the day. So there's always essentially potential opportunity to trade this market. Another advantageous part of why you should trade the energy sector, in particular MCL, is because this contract in particular is actually cash settled. Unlike many of the other crude oil contracts, specifically the larger ones where there are actual physical commodity deliveries on this products, this contract in particular is cash settled. So that is nice because it's a micro contract, it's cash settled, and it's in the crude oil market, giving you opportunity to trade the energy sector without having to worry about physical delivery of the product. And finally, with these products, you can trade both long and short in the futures market. There's no PDT rule, so you don't need 25,000 in order to day trade these. You can go long or short, and PDT rule does not apply. So now that we've touched on why trade energy products, let's move on to the next slide and discuss why trade micro-sized crude oil futures compared to the E-mini or the regular size futures contracts. Well, as you can see here, basically the answer is the number of customers today are demanding smaller size, and it's hard for the average newcomer or retail trader who may not have enough to invest into these larger contracts. The larger crude oil contracts have larger margin requirements, larger minimum price fluctuations, and aren't as newcomer friendly, if you will, as the micro crude oil futures. And again, this is all our opinion. But there's a very large number of contracts being traded on this contract. Like we discussed, there's a lot of volatility, so there is constant movement. And if, like I mentioned, you're a beginner trader or someone new to this product, trading the micro futures or the micro crude oil may potentially not have as a devastating effect on your account if something goes wrong with your trading. Now, we're not here to downplay the risk of futures in general. All we're saying is that the smaller contracts have less leverage, so it could potentially have less of a devastating impact on your account while trading these products if something does go wrong. So let's go ahead to the next slide and actually put this in perspective by looking at some numbers here. And we're going to compare the micro crude oil contract to the E-mini crude oil compared to the larger WTI crude oil futures. So as you can see here, we have the new micro crude oil futures in the left-hand column in the blue. And as you can see, if you look at the contract size, it's only 1/10 of the size compared to the normal contract. And as you can see, same with the minimum price fluctuation. If something goes wrong and the market is moving quick, and as we've discussed multiple times now, this is a volatile market. The micro contract, because of the minimum tick or price fluctuation value, can potentially be a lot less devastating on your account. Yes, there's always the opposite end of the spectrum as well, but when it comes to losses, this product requires a lot less leverage to enter, and because of that, there's technically less risk involved with this contract. And you can compare that to the regular futures contract on the right here and see the differences for yourself and how that could potentially impact your own account. Moving on from there, as discussed before, the product code for the new Micro Crude Oil futures is MCL. And as we have mentioned, the settlement for this is financial or cash settled. And as we have already discussed, you can see the trading hours here. If you're in Chicago time or Central, the market is closed from 4 p.m. to 5 p.m. Central time. Everything else, basically 23 hours a day, 5 days a week. So again, feel free to take a look at the different product sizes here so you can compare the differences and why it may be advantageous as a new futures trader or someone new to the financial sector, specifically crude oil, why starting off with the Micro Crude Oil could be a very good starting place for you. So now that we've knocked out the different contract sizes and the differences between the new Micro Crude Oil and the other crude oil products, let's move on to another advantage or potential advantage of why you may want to trade the Micro Crude Oil over some of the other products. And one of the biggest reasons is scaling in margins, which is key for day trading. So as we have seen with some of the micro products on the indices side, such as the MES and MNQ, which have been fairly successful since their release, one key for day traders is the ability to scale in and out. And we can compare this to the MCL. We've seen it in the past where as a day trader, you may want to have the ability to scale in and out of positions, but we tend to see that it frustrates traders when you have a smaller size account and you want to do the same scalability, but the products you're trading either have a margin requirement that's too high for the account, or the contract size is too big. Then it implies too much risk on the account in general. With micro crude oils or micro products in general, you do have more flexibility with the smaller margin requirements and smaller contract sizes to have the ability to scale in and out without implying as much risk on your account. For example, let's say you want to build a position of 2 to 3 contracts, right? So with the micros, you can go in with the smaller size and continue to add smaller sizes with, let's say, 3 contracts, which technically, if you think about it, is only a third of the regular crude oil contract, right? It's a tenth of the size less. So going in with only 3 contracts is only a third of the size. Then you can scale in and out as needed. And again, this all implies less risk on the account. You're using less leverage. And if things potentially go wrong, you could scale out of these positions rather than have, one single move take out your account on the large product. So if the market goes in your favor, you can tend to get out of them one at a time. You can even add more positions if you need to. But if you're trading one single regular crude oil contract, you don't have the ability to do this. You're working with one position, one at a time compared to the 10 at a time that you could be working on with the micros. So you really do have the possibility to scale in and out and have a much more flexible trading style with these positions. And as you can see in the background of the chart, in the background of the slide, as you can see, and just as we touched on, scaling allows you to build into positions. It allows you to either build on those positions at different levels or exit at different targets and levels. You can trade longer time frames with less leverage. The margins are much lower. If you are a long-term, trader, this only requires $530 to hold overnight. And as you can see, if you're an Optimus Futures client, if you're interested in day trading these products, at the current time this video is being made, There's only $100 day trading margins on this. But please keep in mind that margins are subject to change and can potentially change at any time. As we've discussed before, we always advocate to take less leverage on your account. It helps with longevity, and there's less risk. It allows the market to breathe a little bit and allow you to stay in positions longer and have the easier flexibility and time to manage these positions rather than possibly going all in on one of the larger contracts at once. All right, now moving on from the last slide, let's take a look at how you could use these products to hedge either for traders or long-term investors. Now, as you can see, our first bullet point here, that it can provide diversification for equity traders or for investors. And let's go a little bit further and discuss that. So you could basically use these as a hedge for long-term investors. When energy prices are really high, equities typically tend to go down from what we have seen. It affects things such as transportation costs quite heavily, and consumer consumption can potentially go up or down. And because of this, people travel less, they buy less things of that nature, and they need to save. And in a bear market, what you want to potentially do as an investor, if you have a large equity, is you can use this smaller contract. You don't have to trade the big contract. You can trade these micros and trade it against your own positions. For example, if you are long or have bought a crude oil contract, when it's going up, you can basically maintain your portfolio because, it is very hard to turn around when the market's going up and go short and short your entire portfolio, because then you get into the business of trading, not investing. So as an investor, you can use this as a carrier position. You have to learn about the futures market, of course. There is a lot to it. We have just barely scratched the surface in this here presentation. You need to learn about things such as margins, how these positions works, when you can operate, but we're here to help you. So of course, if you have any questions on how you may want to implement this type of short or long-term trading or use these futures positions as a long-term hedge as an investor, feel free to give us a call and we'll help you out. In moving on to the next slide, how to get started trading micro futures or micro crude oil futures. As you can see, we have a free trading platform. It's called Optimus Flow. It's a white label platform that we created. We can provide it free of charge. It has fast execution. It has charts. It basically is all in one, has everything you need. If you do have a preferred trading platform, you could open that as well. We could help you open up a small account. We'll help you choose a clearing firm that best suits your needs, has the best margins, pricing for you, and availability of platform and different data feeds. Again, we can help with opening small accounts, and as we discussed, these products at this time only have a day trading margin of $100. But please keep in mind, small account or not, there is still a lot of risk associated with these products. Like we discussed, this is a volatile market. It's based on crude oil, which is constantly fluctuating. We have seen these products go negative in the recent past. So whether small account or large account, there is risk associated with trading any type of futures. And we mentioned that in the disclaimer, and we'll continue to mention it again. Piggybacking on that point, if you are looking up to open an account, feel free to give us a call and consult with us. We'll help you formulate a game plan, help you choose the right account minimum in regards to the products that you wish to trade, how many you wish to trade at one time, the margin requirements of these products, and how to navigate through that aspect. Up next, our commission schedule. I encourage you to take a look at our website, to take a look at our competitive commissions. We are catering with low commissions for self-directed traders. On to the next point, if you qualify and meet trading account standards, we can help you open an account within 24 to 48 hours, 1 to 2 days. We have proficient back office team. We specialize in opening up accounts, so we'd be happy to help you up with that aspect. And as discussed, we do have a free trading platform, Optimus Flow. In the very near future, we will be adding a fully customizable and in-depth trading journal that you can use to analyze your trades. So if you are new to the futures trading industry, or in particular trading micro crude oil contracts, this could be a great way to begin to analyze your trades, see where things went right, see where things went wrong, measure your performance, see different ratios, your risk, your reward share, over trading if you're not trading enough. We'll give you comprehensive insight into your own trading. So this is something to look forward to. It will be free, so feel free to get in touch with us if you're interested in that. And wrapping up again, if you're interested in anything we talked about here today, as you can see, or as I mentioned with the commission structure, margin requirements, if you aren't interested in using Optimus Flow, again, we cater towards 40, 50 different platforms that we support and provide for our customers. Feel free to take a look at our site and see the platforms that we support, the data feeds we offer, and what's available to you as a trader under Optimus. Go to www.optimusfutures.com. If you do have any questions, specific questions, would like us to give you a call or would like to set up a meeting, feel free to drop an email to support@optimusfutures.com. We'll help you out. And like I said, we'll help you formulate a game plan on how we could help you. For international clients, you can give us a call, 800-771-6748. Or for local customers, feel free to give us a call at 561-367-8686. That just about wraps it up for today's presentation. We hope you enjoyed this webinar and PowerPoint presentation today. Just to mention again, that past performance is not necessarily indicative of future results. And we wish you well, and we look forward to hearing from you. Thanks again, and we hope you enjoyed.